Welcome, dear viewers. My name is Paul Buitink, and I'm very pleased to have a conversation today with author and financial analyst Jim Rickards to talk about what's next for our economic and financial system. Jim, welcome.
Thank you, Paul. Great to be with you.
Good to see you again. We're in the biggest depression since the 30s, possibly even worse than that. Balance sheets of central banks and governments are being pumped up as a result. Trillions of dollars, euros, and other currencies are being created to support the economy. If we look at the US first, do you support the measures taken? Would you also have taken those measures yourself if you would be in charge?
Well, first of all, on the depression point, you're right, and it seems to be pretty well understood. Where we are right now. Let's just say the second quarter of 2020. And I'll speak about the United States. It looks like on an annualized basis, our economy will crash 30 to 40%. And there's never been a number like that. This isn't 3 to 4% that you get in a bad recession, 30 to 40%. So on an annualized basis, that would be $6 trillion of lost output. Let's say that we have about a $20 trillion economy. 30% of that annualized would be $6 trillion. So that much seems to be known. Of course, we all know what's prompted this. It was the pandemic, and you can debate responses to the pandemic. Sweden has taken a fairly light-handed approach. South Korea took a heavy-handed approach. The United States is a muddle. We did a little of both. We got off to a late start, but then sort of moved to a more extreme form of lockdown. So I'll leave that debate to others. But there's no debate about the economic impact this quarter. The question is, where do we go from here? Is this the famous V-shaped recovery where it goes down and comes right back up again, and by the end of the year, everyone's celebrating Christmas, it's all good? Or is this, the L-shaped recovery where it goes down, it doesn't go down further, but it doesn't go up a lot either. We just sort of poke along at a lower level of output. Unemployment remains high, growth remains weak, et cetera. And that's a huge difference, of course. My view is that we're in for the L-shaped recovery, that, we've gone down, some very large number, 30 or 40% annualized, might take GDP down 7% for the full year. But I don't look for a robust recovery. In fact, there'll be very little recovery at all. There are a lot of reasons for that. We can get into it. But I think this is, it will be years before the United States gets back to 2019 levels of output. And it will be years before unemployment gets anywhere, even below 10%, let alone back to the 3-4% levels we had just a few months ago.
Yeah, because 26 million new jobless claims over the past few weeks alone. I think in the US, there's a working population of over 150 million. So if I calculate correctly, does it mean 17% unemployment additionally based on these claims?
Yeah, perhaps higher. I mean, you're right about the numbers. 26 million Americans have applied for unemployment benefits, basically meaning they've been laid off or fired just in the past 5 weeks. That's true. But we're not done yet. These figures come out every Thursday morning at 8:30. There may be, I don't know the number, but there may be another 4 or 5 million next Thursday. This number may be as high as 30 million. We'll get the April unemployment figures next Friday, basically the first Friday in May. But you could be looking at 25% unemployment. That is, obviously it's it's an extreme hardship for those who are unemployed. But the question, of course, is how quickly will it come back? And a lot of people say, all right, the restaurants are closed, theaters, concerts, bars, restaurants, gift shops, dry cleaners, any non-essential small businesses in the United States are basically shut. So at some point they'll reopen, and there's a sort of a movement. May 15th is a big date. Some states will reopen sooner, some later. But let's just jump ahead a little bit. Let's just say by June or July, most of these businesses will reopen. Well, it doesn't mean they're going to hire back all these workers. If you had a restaurant and you had 20 employees and you closed your doors and fired 20 employees, and then in July, let's say you reopen, you're not going to hire back 20 right away. You might hire 10 and see how it goes. You might not have as many customers. Your revenues might be down. You might have to separate the tables to keep social distancing. So the point is, Could you reopen your doors by July? Yes. But it doesn't mean that you hire the 20 people back. You might only hire 10, as I say. So the other 10 are permanently unemployed, at least, for a extended period of time. Some of those people will just drop out of the labor force. You might see the unemployment figures getting better rather, not because so many are being hired back, but because you're actually shrinking the denominator, the fraction, with people quitting the workforce permanently. And then that assumes you're able to get back in business. And even if you do, your revenues will be down. What about the people who don't make it? What about the businesses that file for bankruptcy? A lot of these businesses are not going to just reopen their doors. They'll be gone. And these kinds of businesses don't have working capital. They have revenue, they have expenses, there can be a profit for the owner, but they don't have $5 or $10 million in the bank as working capital to get through a period like this. And I wouldn't underestimate the impact of small business in the United States. People, stock market investors, the stock market has shown a little, it hasn't come back nearly all the way, but it's shown a little bit of a rebound. But, the stock market is, it's Boeing and General Electric and General Motors and IBM, a lot of other large public companies. But small businesses are 44% of total output and 47% of total jobs. In other words, almost half the U.S. economy is in the small businesses that we were just describing, not in the major publicly traded corporations. So if that sector was shut down, which it is, and if a lot of it doesn't come back, which they won't, and if those who reopen the doors don't hire all the employees back, which they won't, then we're in for a very long, very dangerous recession. I would call it a depression, and a very slow, painful recovery.
Yeah, but if a lot of those companies have no chance of survival after the lockdown is over because of social distancing or because of other measures, does it make sense then to keep these companies afloat, or should they go bankrupt, and should the entrepreneurs themselves or the families be helped by direct cash instead of keeping these companies afloat for all these months longer? Like airliners, for example, of course, we will fly a lot less in the future. So how much sense does it make to keep all these people on the payroll for many months to come?
Well, first of all, I mean, a lot of them are not on the payroll. I mean, load factors, the flights are down 90%, and the load factors on the remaining flights are low. So the airline industry has been hit the hardest of all, except maybe cruise ships, theme parks, airlines, resorts, Las Vegas. They've all been completely shut down. Now, as far as propping them up is concerned, it's not the intention of the government to do the companies or the stockholders any favors. It is the intention of the government to protect employees as much as possible. So we have a small business lending program. It's been given over $600 billion, a huge amount of money, the so-called payroll protection plan. So the government's giving loans to small businesses. They vary, they could be $50,000, could be several $1 million. It's not intended to go to large publicly traded corporations or large companies at all. But the deal is, if you get one of these loans, you can't fire anybody. And if you go several months without firing anybody, the loan becomes a grant. You can keep the money. But bear in mind, it's not, you can get the money and you can keep the money, but it's for the purpose of keeping your employees on the payroll. And if you fire them anyway, which you have a legal right to do, you have to pay the money back. And so what's the purpose of a loan like that? Well, it's to avoid making unemployment worse than it already is. Will it work? Look, as a short-term fix, probably yes. And I'm not sure, nobody likes to do this, but nobody likes to be in the situation we're in. So as a way of keeping unemployment from getting worse than it already is, and as a way of keeping some of the doors open, it's probably necessary. But I would not. But it's temporary. This will get you through a couple months. This might get you through May and June. Now, if you assume that by July everything comes back to normal, then you would have to applaud the program and say it did its job. But but my view is it won't come back to normal. Like, you've got a 2-month bridge loan, but it's a bridge to nowhere, in the sense that by July or August, a lot of these, even with the loans, a lot of these companies won't make it, and many won't qualify for the loans. And even those who do and keep some employees on the payroll, it doesn't mean their revenues and their customers are coming back anytime soon. I mean, I'm not, I travel a lot. I travel all over the world, but I'm not dying to jump on an airplane right now. So
Exactly. Same here.
I don't think we can underestimate the psychological burden. This is not just economic. It's going to change behavior, maybe on an intergenerational basis.
Yeah, and going back to my first question, what would then be the, given the fact that you expect an L-shaped recovery, what would be the right response from governments going forward? Do they need to keep on bailing out industries or providing loans, creating more money? And what is the consequence of all that monetary expansion, you think?
Well, there's never been anything like it, so I would be a little bit humble about predicting the consequences because we've never seen this before. But a couple of things. In the short run, short run, kind of maybe intermediate run for the next year or so, our biggest problem is going to be deflation. You know, the monetarists and the Austrian economists and you know, the Milton Friedman people and the neo-Keynesians, they all say, hey, you print all this money, you're going to get inflation. That's not true. Printing money has nothing to do with inflation. Inflation is a psychological phenomenon. It has to do with the velocity of money or the turnover of money. So can the government print money? Yes. Can we run a deficit? Yes. Can we get money into people's hands? Yes. But it doesn't mean that people spend the money. They could get the money and they could pay down debt. They could get the money and save it, which they will. This is the famous liquidity trap, which, you know, John Maynard Keynes diagnosed as early as the 1920s. So the government has a very good capacity to spend money, but they spend it by giving it to people. And giving it to banks. It doesn't mean that the people spend the money. And if they're paying down debt and saving it, which I expect, and there's already some evidence of that, you're not getting the velocity. I like to tell people $5 trillion times zero is zero, meaning you can increase the money supply by $5 trillion, but if the velocity of money is zero, then you have no economy. And that looks like what we're walking into. So you're going to have to do something else. And there are two things you can do. Number one, we can accelerate the decoupling from China, basically bring the pharmaceutical industry back to the United States, bring the electronics industry back to the United States. Will it raise costs a little bit? Yeah, it will, but
it will take years too. This is like
it will take years, but you can start today, and that can create some investment. Remember, investment is part of GDP. It's not just, U.S. has been so driven by consumption. 70% of our economy is consumption. How about trying a little investment? You know, new plant and equipment, et cetera. And then those jobs I'm talking about in pharmaceutical and electronic industries, those are high paying jobs. Those are often union jobs. Those are jobs that come with benefits. Will it raise the cost of pharmaceuticals a little bit? Sure. But that's like paying insurance or buying a call option. I mean, that's the price you pay to have secure supply chains. This will hurt China, but, you know, China doesn't deserve our help because they're human rights violators, they're communists, they're atheists, they have nothing to offer the world, and it would be much better to get those jobs back to the United States. So that's one thing we could do. You know, beyond that, we're going to need some inflation. The economic unemployment's a huge problem. It's a personal, you know, tragedy for those affected. But if you want to get people back to work and you want to get velocity going, which is what you have to do, and you want to change the psychology, which is what you have to do, you're going to need inflation. We're going to be fighting deflation. So how do you get inflation in a deflationary environment? There's only one way to do it, and it's not by printing money. It's by raising the dollar price of gold, because gold is not a commodity, it's money. It's been done twice successfully by President Roosevelt in 1933 and by President Nixon beginning in 1971. In both cases, they devalued the dollar against gold and raised the price of gold. But it's not an end in itself. It's not designed to reward investors in gold. It's designed to change the psychology, because if the dollar price of gold goes up, guess what? You know, the world of $5,000 gold is the world of $200 oil, $100 silver, $20 copper, etc.
Why would that be then? How's the rest going to, let's say the Fed decides to revalue gold for $5,000, then I would
Right.
probably, maybe I would sell my gold to the Fed. So
Yeah,
that's the
they
practical
would say,
question.
they send it in,
Yeah.
we'll send you the
Send it
money,
in.
no problem. They'll print the money to do it, by the way.
Yeah.
It's just an open market operation. It's what they do with bonds.
But how would
they
it raise the price of other goods then?
Because nothing happens in isolation. You don't just raise one commodity price and everything else stays the same. The shock of it would not destroy, but it would greatly diminish confidence in the dollar. And people would say, oh my goodness, I better go buy that new car. I better buy that new house. I better, get my commodity shipments in before the prices go up. By the way, this has happened. This is not theoretical. This is exactly what President Roosevelt did in 1933. He raised the price of gold. He did not do it to reward gold holders. In fact, he confiscated all the gold before he did it. It was the ultimate insider trade. But the reason was not just to devalue the dollar. The reason was to devalue the dollar, but that played out in every other market. 1933, in the middle of the Great Depression, was one of the best years in the history of the stock market. Unemployment started to come down from 25% to 10%. It was still high, but it came down. The stock market rallied. What Roosevelt wanted to do see, people say raise the price of gold, but when you raise the price of gold, what are you really doing? You're devaluing the dollar. It takes more dollars to get your ounce of gold. So what you've done is you've devalued the dollar. Roosevelt wanted the price of wheat, corn, cotton, steel, copper. He wanted all those prices to go up, and they did. And the same thing happened in the 1970s with oil and every other commodity. It was a great commodities boom in Africa. And by between August of 1971 and January of 1980, the price of gold went up 2,600%. But the price of everything else went up. And that's the point. Roosevelt did it intentionally. Nixon did it by accident. But the point is, it works.
Yeah, and what about, a lot of people talk about helicopter money. If you just create large enough amounts and send it directly to citizens and families, let's say everyone receives $50,000 or euros, do you think that could break the low velocity and would incentivize people to spend like crazy?
50,000 a year times 300 million Americans is a lot of money. So, what you're really talking about is changing the psychology. Could that change the psychology? Possibly. I wouldn't want to rule that out. It's not going to happen, by the way. The 50,000 times 300 million, that's a big number even for the United States. But the point is, printing money and handing out money and sending money. Right now, our Internal Revenue Service is wiring hundreds of millions of checks or wire deposits to individual accounts. It's not 50,000; it's about $1,700. But
which is nothing, right? It's just
it helps. I'm sure it'll help somebody pay the rent this month, and that's a good thing. But my point being, if people pay debts, pay bills, and save it, which they will, that does nothing for velocity. That's not the marginal consumption that you need to actually cause inflation. So what you have to do is change the psychology. And the fastest, best proven way to do that is to raise the dollar price of gold, not to reward gold holders, but to change the psychology and get the price of everything else to go up.
That's funny. It's one of I still have Currency Wars here. It was the book I bought 9 years ago, I think. And I was just reading the conclusion and the different scenarios for the financial system in case a new crisis would come. And some of the things are eerily realistic, especially the chaos scenario. What happens currently is sort of a chaos scenario, I think. But what would be the consequence for the international monetary system should the Fed decide to, or the Treasury raise the price of gold? What would be the consequence, for example, for the euro? Is there still a life for the euro after that happened?
Yeah, I expect the euro to remain. I don't think the euro system is going to break up. It's under a lot of stress right now. They're suffering economically, maybe even worse than the United States. They'll have to get through that, but I think the euro will be around. But I guess the point I'm making, it's not as if you can devalue the dollar against gold and the euro is going to be strong. The euro is going to go with it. In other words, an increase in the dollar price of gold is also going to be an increase in the euro price of gold. Now, the euro US dollar cross exchange rate might not change very much. but it's a meaningless statistic. I mean, it's important if you're a currency trader. It's important if you're in the export-import business. I understand all that, capital allocation. But think of all the currencies as passengers in a lifeboat. So the boat sank. Some stragglers are in a lifeboat. They have no food and water. They're all a little bit desperate, but they're all in the same boat. So saying the euro is stronger than the dollar is stronger than the euro is kind of an unimportant statement because they're all in the same lifeboat. The only way out of this is with gold. So here's what will not happen. You will not devalue the dollar against gold and have the euro stay unchanged. The euro will also devalue against gold, and so will the Japanese yen and pound sterling and other major currencies. They'll all devalue against gold together at the same time. But that's the end of the currency wars. Meaning, I said in my book, Currency Wars, you know, if I devalue the dollar against the euro because I want to help U.S. exports, well, Europe just devalues the euro, and so it's like, you know, you get these competitive devaluations that doesn't accomplish anything. It's mathematically impossible for all currencies to devalue against each other at the same time. It's a mathematical impossibility. If the dollar goes down, the euro has to go up. Or if the euro goes down, the dollar has to go up. But how do they both devalue at the same time? How can you devalue the dollar and the euro and the yen and sterling
against
all
gold
at the same time? The answer is against gold, because gold is not printed by a central bank. And that's what they'll do. Now, the interesting thing to me is, does that happen as a matter of policy where the U.S. government makes it happen? Or does it just happen by market forces where, you know, I think investors have a fabulous opportunity to front run the government right now. Yeah. If you say it's going to happen eventually, which it will, why not get some gold now and be the beneficiary?
If you allow me, 2 more questions,
sure.
Short ones, possibly or not. Depends on the answers, of course. SDR. What is your view on that? Because I know you were quite vocal about it in the past, and there were some talks within the IMF to possibly allocate more SDRs. Do you think it's going to happen? And if so, how would that affect liquidity for example, developing nations?
Right. Liquidity is critical. And I hypothesize that in the next, well, of course, I said this in 2012 and 2016, and as recently as last fall in my book Aftermath, which obviously looked ahead and saw this current financial crisis. But I said, you'll have a liquidity crisis and you'll have to resolve it. And how do you do that? Well, one way, of course, which is what we're seeing, is the Federal Reserve will double its balance sheet, which they have. They're on the way to $10 trillion. My hypothesis was that, and it may prove to be true, but it hasn't happened yet, is that there's an invisible confidence boundary that legally, can the Fed do it? Yes. Modern monetary theorists would say, hey, no problem, just do it, And
magic money tree.
But they're doing it. That's the thing. They are doing it. So they've blown, I was estimating around $5 trillion might cause a loss of confidence. Well, they've blown past that. They're at $10 trillion. So as long as they're doing that, you don't need SDRs for global liquidity because you're going to have plenty of dollars out there. How it works remains to be seen. But there has been some talk about issuing SDRs, exactly what you described, in a very large amount, perhaps 1 trillion SDRs. But here's the problem. When you issue SDRs, they have to be handed out to all the members of the IMF according to their voting rights and their capital accounts. It's sort of you can't give more to one country than another just because they need it more, you like them better. It has to be according to the rules. Well, that means a lot of this would go to Iran and China, and the
Venezuela.
Venezuela. And the U.S. is opposed to that for geopolitical reasons. So, and the U.S. has veto power. You need an 85% vote in the IMF to make something like that happen. Guess what? The U.S. has 16% of the votes, which means if every other country in the world disagreed with the United States, they could only get 84% of the vote. So the U.S. has veto power. Right now, the White House is saying, well, not publicly, but my best information is that the U.S. will not approve an issuance of SDRs because we don't want to help Iran because of their nuclear weapons program, their missile testing program, their promotion of terrorism, their violation of human rights. Yeah. So I don't think we're going to see SDRs in the near term, because the U.S. will oppose it.
But
Now,
there's always a country, of course, where the U.S. has problems with or is at war with. So in that sense, SDR is not going to fly anytime soon.
right. Welcome to the financial wars.
Yeah. Final question. A lot of people have embraced over the past few years new cryptocurrencies such as Bitcoin. I saw also Jack Dorsey from Twitter now has changed his bio and it just says Bitcoin, and the guy has over 4.5 million followers. Raoul Paul calls it a great option on a financial system. What's your take on it?
Yeah, I think Bitcoin is junk, has no use case. It's good for it's sort of good for terrorists, criminals, tax evaders. So that's the use case. I could see it settling around $200 a coin, maybe. It's, it's speculative. I like to go to casinos and play roulette. I don't always expect to win, but I enjoy the game. Bitcoin is sort of a disgrace. I mean, it's led to a lot of suicides, a lot of massive financial losses among people around the world who can least afford it. It's a zero-sum game, and it's massively manipulated, and it's a massive fraud. Other than that, it's all good.
Okay, great. Any final remarks from your end?
Yeah, one point I would make is that this is our third financial crisis in a row at about a 10-year tempo. And I talked about this in my book, The Road to Ruin. I talked about 1998, then 2008, and then I hypothesized 2018. I wrote the book in 2016, so I was looking ahead. All right, so I was up by a couple of years, but here it is, 2020, and we have our third great financial crisis. And I was trying to draw lessons from the last two as to what you should do to prepare for the one that we're in now. And a lot of people have written to me lately, and on Twitter or email or whatever, to say, I wish I'd read your book sooner, or I wish I'd done what you recommended. And well, that's okay. It's not too late to take steps. But the point I made is that in the 1998 crisis, which peaked in September 1998 with the default of Russia and long-term capital management, that actually started in June 1997 in Thailand with the devaluation of the Thai baht. So it took over a year to go around the world. In the 2008 crisis, we all remember Lehman Brothers, AIG, and the rescues in late 2008. But that started over a year early faults, and there was a collapse of a couple of Bear Stearns hedge funds in July 2007. But it culminated, it peaked in September 2008. So that also took a year to go around the world. So the lesson of the last two financial crises, they start somewhere, but they're not over soon. They take a year to a year and a half to peak. And so if this crisis started in, you could say February, March, take your pick, of 2020, is the disease going down? It looks like yes. Will the economy find a bottom? Probably yes. We can debate how quickly it will come back, but this may not be over. This may actually have a second wave or a third wave and may actually kind of reach some peak in 2021. So it's still not too late to prepare for what could be a worse phase of this crisis.
Okay, well, that's invaluable advice to our viewers. Thanks a lot, Jim, for your time today, and talk to you in the future again.
Thanks, Paul.
Bye.